Hello guys, welcome back to another lovely trading video. In this one we're going to be going through how you can use cash secure puts, kind of what they are, how you can make money using them, and kind of the benefits and the disadvantages of using cash secure puts for trading and or investing. Now we're going to use Shopify as our example just because if we were looking to do some cash secure puts, it's at a level where we'd be looking to do them. Now go through it. If you don't know at all kind of what they are, we'll kind of give a quick brief understanding, and all it really means is you sell a put. So all it basically, so cash secure put is just selling a put. So all that would literally mean is you go here and you literally just sell it. Now what are your requirements for this? What is your max risk in all of this? Well, so for this, you're going to need to be able to afford 100 shares, because that's kind of what a cash secure put is. It's saying if the price is at here or below, you'll buy 100 shares. So obviously for something like Shop, it's going to be very expensive. You're going to need around 80 grand. But you can do these on anything. You could do this on something like Ford shares where they're $20 or $20 or $15. So then you don't need all that much money to actually be doing these trades. It would be much closer to a grand and a half. But we're just going to go through Shop because it's just a stock that we would be looking to do it on. And either way, it's still the same concept, whether you're looking at a $5 stock or a $500 stock. It doesn't make a difference. So yeah, basically all you need to do then is pick a strike. For example, here we're going to use $800 as a strike price. And all this means is if we sell a put at the strike price of $800, and we can see here this is going to expire on the 25th of February. This is us saying if Shopify is at $800 or below on the 25th of February, we will buy 100 shares at $800. And this is some sort of the risk you take when doing cash secure puts, because this means if price is at $700, if Shopify is at $700, you still have to pay $800 per share to buy them. But now what are you thinking? Okay, well that just sounds like a downside. What is the upside? Well, you sell the put in advance. So here we can see the bid is around $40 and the ask is around $47. So let's just say we make $40 for selling this put. This means we make $40 per share, and obviously an option is 100 shares. So that means we will make $4 grand for selling this put. So this just means if Shopify, no matter what happens, whether we have to buy them or not, no matter what, today we would make $4 grand. And then it means comes the 25th of February, if Shopify is at or below $800, we have to buy 100 shares at $800. But no matter what, we still keep our $4 grand, and that is our incentive, is you keep that premium. And this is why we take it on stock where either we're very happy to buy it at this price, we consider it very discounted, or it's just very unlikely to be staying at this price in, say, a few weeks, months down the line. And Shopify is one where we don't see it kind of staying at this price, say a month down the line. And why is this? Because when we're looking at Shopify, we see it's down at the third deviation, and depending on your own strategy, you're going to have a kind of a way to see if a stock's cheap or expensive. But for me, very quick way to kind of see if a stock's cheap is if it's at a third deviation, which is that green line you can see. We would see that as very discounted, and we expect price to at least return to that level and above. So to me, selling a put at $800 is extremely low risk because I don't expect price to be there. So in this case, I'm very happy to accept $4 grand in premium to take on that risk, because I know 9 times or 9.5 times out of 10, I'm not going to have to buy the shares. And that's the thing with the cash secure put, is you keep that premium, so that $4 grand no matter what. And if by the 25th of February, Shopify is at $800.01 or above, you then don't have to do anything. All you do is you keep your $4 grand and you don't have to do a thing. And that's why I like this strategy, because either way, you can't really lose as long as you're doing it on a stock you want. And I'm going to go through one more example on this to kind of show you what I mean. Is I don't want to say it's a risk-free trade, but if it's something you're looking to invest or trade in, then you can kind of get it risk-free. And by that I mean, for example, JP Morgan at $144 or $145. To me, that is very low risk, and it's something I'm happy to hold at that price. If I own JP Morgan at $145, I'm happy to buy at that price. So to me, if I sell a cash secure put at say $145, expiring in a month's time on the 25th of Feb, I'm getting paid around $500 per contract I sell. So that means no matter what, today I will make $500. If JP Morgan in a month's time is at or above $145, I keep that $500, I don't have to do a thing. Let's say JP Morgan's down at $145 or $144. That means I have to buy 100 shares at $145. So essentially I'm paying $100 more than I have to, but I still keep that $500 premium. So essentially I still make $400 for that trade for each contract that I sold. But it also means as long as JP Morgan is above $140, it's instantly a winning trade when it expires. But either way, let's say JP Morgan's all the way down at $135 at the 25th of Feb. If I'm doing it at a stock where I see it as low risk, I see it as a discounted price, I'm happy to own the shares. And this is why it's more used as an investment strategy than it is a trading strategy, because it's more something if you're looking to hold something long term. For example, JP Morgan, I mean, if you hold a banking stock, JP Morgan's probably the best one to be holding. It is one of the best performing banking stocks, arguably one of the best banks, depending on what you like. Probably one, or at least one of my favourite CEOs. You've got Jamie Dimon. So either way, I know this is a stock I'm happy to own at $145. To me, that is cheap. So if I'm getting paid $500 to buy 100 shares at $145, I don't care if it goes down to $140, $135, because I would have bought it anyway at $145. So it's really the way to use them. Cash secure puts are a great way to use if you're looking to buy a stock. What you can do is essentially just get paid to wait for it to come down to your price, because you can just keep selling them. And by that I mean, let's say we want to buy JP Morgan stock. We want 100 shares kind of whenever. What we can do is we say we want 100 shares of JP Morgan, but we want them for $145. And then what that means is we can come over to the option chain. You can sell them on the weeklies, you can sell them on the monthly, whatever, it doesn't really matter. You can sell them in a week's time, 2 weeks' time, a month time, whatever. And so we could, for example, go to the 4th of Feb, so 2 weeks down the line, and we can say we can sell our puts at $145. So again, we're getting paid $300 to buy shares of JP Morgan at $145. And if that's what we want to do, let's say if we were just today, we were going to buy 100 shares of JP Morgan, and we wanted them at $145, then what's really your risk? Either way, you're getting paid $300. If price goes up, you don't even have to end up buying them, you just get the money for free. If price goes down, you were going to buy them at $145 anyway, so either way you offset your risk by $300 because you're getting paid to buy the shares. So really that is kind of the brief example of cash secure puts, how they work, kind of your risk associated with them, the benefits of using them. Again, probably better to be using as a investment strategy, not so much as a trading strategy. But either way, I hope that kind of makes it clear. If you have any questions, just put them in the comments. I know options can kind of be a bit hard to understand and all of that. So either way, I hope you enjoyed the video. Hope you see you in the next one, and that's it. Peace. I go dumb for that money, dumb.